The total debt of governments around the world recently surpassed $100 trillion, a number so high that it's hard to even conceptualize. But why is there so much debt? Who is all this money owed to? Will it ever be repaid? And when does this massive debt pile become a problem? My name is Guy, and today we're going to find all the answers. This is Coin Bureau Finance. Stay tuned. Before we begin though, I am not a financial advisor and nothing in this video should be considered financial or investment advice. It's educational content to inform you about government debt. And if you want to see more videos like this, then punch those like and subscribe buttons and flick that notification bell too, so you don't miss the next one. Now, let's start with some numbers. We all know that the world is massively in debt, but just how bad is it? Well, according to a recent publication by the Institute of International Finance, or IIF, total global debt now sits at a jaw-dropping $338 trillion. But of course, not all of this is owed by governments. Broadly speaking, economists split debt into three core categories: public debt, the money owed by governments; corporate debt, money owed by businesses; and household debt, money owed by families and individuals. And obviously, the debt we'll be focusing on for the purposes of today's video is the public debt. As I record this, the global total of government debt is estimated to be more than $110 trillion. That sounds like a lot until you remember that a government's debt burden ultimately depends on how big the debt is relative to the country's GDP, or gross domestic product. Now this basically measures a country's economic size by totaling the value of everything it produces, including consumer and government spending, net exports, and investments. You can think of GDP as being like a government's overall income. Now, having large debts is fine so long as they have the income to service them. So, with that in mind, let's look at which countries have the biggest debts. As you might have guessed, the US tops the list with over $39 trillion worth of public debt. This accounts for around 133% of its GDP, meaning that the US has taken on more debt than it can pay back with its current economic growth. The craziest part is that many other countries are in worse shape. China ranks in second place in terms of government debt with over $20 trillion, or 110% of its GDP. Japan comes third with over $10 trillion in public debt, but it has one of the world's highest debt-to-GDP ratios at around 251%. This means that Japan is technically even more underwater than China and the US combined in relation to GDP. And yes, Europe has its fair share of countries struggling with public debt too. For instance, UK government debt is $4 trillion at 110% of GDP. French government debt is $3.6 trillion at 115% of GDP, and Italian government debt is at $3.4 trillion at nearly 145% of GDP. So, there are over half a dozen large countries which are technically underwater on their debts relative to their GDP. However, there are some other countries that have racked up huge debt piles and yet have managed to keep their heads above water, like India and Germany. India has $3 trillion in public debt, which is just 77% of its GDP. It's a similar story for Germany, which has $2.7 trillion in public debt, which is just 58% of its GDP. And we'll leave a handy link in the description for you to check out the national debt of every country, but be warned, it's pretty harrowing stuff. Now, luckily, there are ways to hedge against this growing debt bubble, and one way to do this is with Bitcoin. And if you're looking to buy Bitcoin, then you have to check out the Coin Bureau deals page. That's where you'll find exchange sign-up bonuses of up to $100,000, trading fee discounts of up to 50%, and deposit cashbacks of up to 75% on the best exchanges. Just hit the link in the description or scan this QR code, which will take you to the deals page. There you'll see all of our offers across a range of exchange partners. Simply click one of the Sign Up Now buttons and that should take you right to the deal. Now, these deals won't be around forever though, so take advantage of them while you can using the link in the description below or by scanning the QR code on screen now. So, by this point, you're probably wondering why governments have borrowed so much. Well, the short answer is because they haven't been able to collect enough revenue to pay for their expenses. As we all know, governments primarily rely on taxes for revenue, be that income tax, business tax, or VAT. The problem, though, is that every government wants to stay in power, but few voters want higher taxes or less spending. That's why during election campaigns, most political parties promise to both lower taxes and increase spending, even though this is rarely sustainable. That's why governments will resort to borrowing money instead. Now, most of this borrowing is done by selling bonds to investors, which are essentially IOUs with the promise to pay back those investors fully at a later date, plus interest. So this begs the question of what exactly governments are spending all this borrowed money on. Broadly speaking, there are 5 answers here. The first is to inject more cash into the economy in order to stimulate growth by increasing demand, supporting businesses, and creating more jobs. The second reason is to fund public obligations like pensions, retirement funds, social security, and healthcare. These public obligations are becoming more expensive over time simply because populations are slowly aging. At the same time, the amount of people paying taxes has been shrinking due to the fall in birth rates, which results in more borrowing to fill the tax gap. The third reason why governments have borrowed money is to support their economies during exogenous shocks like wars, financial crises, pandemics, and recessions. And naturally, most of the debt taken on in recent years by governments has been as a result of exogenous shocks like these. On that note, borrowing was incredibly cheap in the years following the 2008 financial crisis. That's because central banks slashed interest rates to near zero and began large-scale bond purchases, known as quantitative easing, to keep financial markets stable. The practical effect of this was that governments could borrow trillions of dollars at low interest rates, so that's exactly what they did. The result was the so-called free money era, where caution was replaced by the belief that growth and inflation would take care of the debt further down the road. Anyway, the fourth reason governments borrow money is to fund infrastructure projects, things like roads, railways, utilities, broadband, and so on. These projects are vital for long-term growth, but because politicians tend to think in election cycles, the focus is often on short-term results rather than long-term economic growth, and infrastructure has fallen by the wayside in many countries. And the fifth reason governments borrow more money is, well, to repay the money they borrowed before. This is known as rolling over the debt, and it allows indefinite borrowing so long as the markets continue to be confident in the value of the government's currency and bonds. If governments roll over debts too much, however, that confidence is quickly eroded. The craziest part of all this, though, is that this wave of government debt is necessary for the financial system to function. That's because government bonds are the safest form of collateral in finance, enabling banks and markets to create new money and extend credit. So, if governments were to stop borrowing and stop issuing bonds, it could actually hurt the financial system, as it could result in a shortage of safe collateral. Okay, so now we know how much money governments owe and why they borrow. The next logical question, therefore, is who do they actually owe all this money to? Well, you'd be forgiven for thinking it's other governments. But in most advanced economies, governments owe the majority of their debt to domestic investors and institutions like banks, pension funds, insurance companies, and mutual funds. Now, bonds are popular because of what I mentioned a few moments ago. They're considered to be one of the safest investments out there since they're backed by governments. But not all financial institutions buy because of safety. Others buy because of financial stability, namely central banks, who have purchased significant amounts of government bonds over the years to stabilize the financial system during exogenous shocks. In the United States, roughly 3/4 of federal debt is held domestically by the Federal Reserve, pension funds, banks, and households, with the remaining 20 to 25% held by foreign creditors such as Japan, China, and the UK. It's a different story with developing countries, though, where a much larger share of government debt is owned by foreign investors. These include private bondholders, international banks, and institutions like the World Bank and IMF. This creates a clear global imbalance in how government debt works. In countries like China and Japan, governments can sustain enormous debt levels without triggering a crisis because they owe that money to domestic investors, meaning it largely stays within the national economy. But in many developing countries, debt held by foreign creditors makes things far more dangerous because this private capital can flee and currencies can collapse when confidence falters. Remember that point for later. And this ties into another pressing question, and that's whether all this government debt could ever be repaid. The short answer is no, and that's because it doesn't need to be. So long as it's possible to continue rolling over debts, governments will keep refinancing old debt with new debt in a never-ending cycle. That said, governments can reduce their debt burdens through inflation. That's because when inflation rises, the real value of debt falls, making it easier to service and repay. This is often referred to as a soft default, where the government repays bonds with money worth less than when it was borrowed, a much safer option, politically and economically, than outright default. If you need proof, just look at the aftermath of World War II. Many countries were left with high debt-to-GDP ratios, and contrary to the popular belief that governments repaid this debt with surplus revenue, it was in fact done using a combination of economic growth and inflation, and in a big way too. For example, in the US, the debt-to-GDP ratio fell from 106% in 1946 to just 23% by 1974. It's not just inflation either. Another tool governments can use is financial repression. This is where governments force domestic investors to buy more of their bonds using various regulations and restrictions, sometimes including capital controls. This allows them to keep interest rates below the rate of inflation, which helps devalue the debt. So, the key takeaway is that as long as governments rely on methods like these, debt will keep growing. What's crazy, though, is that many economists agree that global government debt is reaching unsustainable levels. In fact, just recently, the IMF estimated that global government debt could hit 100% of global GDP by the end of this decade, the highest since World War II. To repay this massive debt, governments would need fiscal measures ranging from the controversial to the downright extreme. In other words, severe austerity, drastically cutting public spending, raising taxes and restructuring, or indeed dismantling entitlement programs like pensions and healthcare. But, to be frank, implementing these measures would be politically catastrophic for whoever had to do it, so it's unlikely to happen anytime soon. Now, everything we've covered so far leads us to the big question I'm sure you're all asking by now. When does government debt become a problem? After all, it can seem like governments are able to run huge deficits without the sky falling in, but that doesn't mean there's no breaking point. As I noted earlier, government debt becomes a problem when confidence falters. When investors stop believing that a country's debt is sustainable, that inflation is under control, or that the political system can manage the pressure, everything can unravel very quickly. This is especially true when debt servicing costs begin to soar. When that happens, interest on the debt can start taking too much government revenue. Investors may tolerate large debts, but if they doubt a government can manage them, all hell can break loose. At that point, the only real way to incentivize lending is to offer higher bond yields to compensate for the risk. That's when a debt spiral can begin, though. Higher rates make borrowing more expensive, which worsens deficits, which then pushes rates even higher. If bond yields spike too quickly, the whole system can become unstable, and we don't have to look far for a recent real-world example. In 2022, former UK Prime Minister Liz Truss and Chancellor Kwasi Kwarteng unveiled their so-called mini-budget. It included roughly £45 billion in unfunded tax cuts, the largest since 1972, and plans to borrow more to subsidise energy bills. However, the government didn't explain how it would pay for everything. Investors duly panicked, fearing higher inflation and soaring public debt. Confidence collapsed, gilts, that is, UK government bonds, were sold off, yields surged and the British pound hit record lows. Within days, the Bank of England had to step in, pledging to buy long-dated gilts on whatever scale necessary to stabilise markets, a stark reminder of how fragile confidence can be, even in advanced economies. And this relates to another danger known as the inflation feedback loop, where central banks monetize debt, essentially creating more money to buy more government bonds. While this can stabilize markets in the short term, it also fuels inflation, forcing rate hikes. As we know, these higher rates then make debt more expensive to service, and so the cycle continues. And not only that, but as investor confidence weakens, trust in the currency can also erode. These investors sell the currency, imports become more expensive, and inflation rises further. It's basically a hidden form of default. The debt is still repaid, but that debt is worth much less. In the worst cases, this spiral can lead to hyperinflation, where prices rise so fast the currency collapses. And this is something we've seen before in Weimar Germany in the 1920s, Zimbabwe in the 2000s, and more recently, Venezuela and Argentina. Once faith in money vanishes, the system breaks down. Savings vanish, trade stalls, and debt becomes meaningless as no one wants to be repaid in worthless money. If that wasn't bad enough, high public debt can also create longer-term problems even without a crisis. One example is the crowding out effect. As governments borrow more, interest rates can rise, making credit scarcer and more expensive for private businesses. Over time, this reduces investment, innovation, and productivity, making the debt even harder to manage. Now, if history is any guide, debt crises don't happen overnight. Instead, they build quietly before the system suddenly collapses all at once. Investors watching government debt aren't just watching budgets, they're watching the future of money itself. Some economists, particularly supporters of modern monetary theory, or MMT, argue that countries issuing their own currency can never truly run out of money. In their view, they can simply print more money to pay off debts, so the real limit is inflation. In theory, this allows governments to use fiscal spending more freely to achieve full employment or fund social programs. However, critics warn that this approach risks currency debasement, where printing money to cover deficits can undermine trust, causing inflation or capital flight. Most economists view MMT not as a blank check, but as a reminder that trust in money and government keeps the system afloat. So, at the end of the day, government debt isn't the villain, it's a tool. But, like any tool, it works only if handled responsibly. Confidence is everything. Once trust in a government or its currency falters, the system can unravel very quickly. So, whenever you hear about record deficits or stimulus packages, remember, debt isn't just numbers. It's a test of trust, and in money, trust is everything. Alright, that's quite enough from me for today. Now it's time to hear from you. Do you think government debt is spiralling out of control? Are you worried about what effect this will have on the economy? Or do you think things will simply plod along as they always have done? Let us know your thoughts in the comments below, and if you could drop a like on this video, subscribe to the channel and share it with anyone you think would enjoy content like this, it would be greatly appreciated. Thank you all so much for watching, and I'll see you again soon. This is Guy, over and out.